It doesn't show up as a fee. It doesn't show up as a loss. It shows up as nothing, which is why it clears your internal filter for problem. Run the numbers without rounding. $100,000 at 0.01% earns $10 in a year. The same balance at 5% produces $5,000, and the $4,990 difference isn't performance, it's position. You didn't choose lower returns, you chose convenience, and the system translated that preference into a permanent pricing gap that compounds quietly in the background. Now, extend it. 5 years is roughly $25,000. 10 years pushes toward $50,000, which at a $90K salary is about 7 to 8 months of after-tax work that never shows up as a decision you made. What makes it hold is psychological, not mathematical. The balance doesn't drop, so your brain logs no damage. Losses that don't create a visible negative number don't trigger action, even when the opportunity cost is larger than any fee you'd ever tolerate. And there's a second layer, safety language. Established bank, insured deposits, easy access, all individually true, but collectively they anchor you to a structure where safety and return are treated as mutually exclusive when they're not. Because the insurance is identical. Up to $250,000 is covered whether it's a traditional bank or a credit union. Same federal backing, different label, which removes the only rational reason most people stay where they are. So the pressure isn't coming from volatility, it's coming from stillness. Money that doesn't move feels controlled, but in this case, it's being priced every day inside a system designed to keep that stillness profitable for someone else. And once you see the numbers laid out this way, the question shifts slightly. Not is my money safe, but who is the current setup optimized for? Because that answer leads directly into something most people never calculate: banking arbitrage. Banking arbitrage. You check the balance before you tap the card. You run the number in your head. It clears so you move forward, even though that quiet calculation never touches the part that's actually costing you. The loss isn't in the purchase, it's in the storage. While you're deciding whether to spend $42, the larger decision, where the other $9,958 sits and what it earns, stays untouched. Scale that out. Do it for a year, then do it for 10, where a steady $100,000 balance at 0.01% returns about $100 total, while the same balance at 5% returns roughly $62,800 with compounding, a $62,700 gap created without a single visible mistake. That gap doesn't feel like loss, it feels like nothing. No alert, no drop, no moment where you say that's where it went, which is exactly why it passes through without resistance. There's a pattern to how you respond. You tighten spending. You optimize small decisions because those are the only ones that present themselves as decisions. So you cancel a subscription, delay a purchase, rework a budget that already works, while the underlying structure keeps pricing your cash at near zero and redeploying it at multiples of that rate elsewhere. The mind reads this as discipline. The system reads it as compliance. You're reducing visible outflow while leaving the extraction mechanism completely intact. And when you finally look for a better option, it usually points back to the same place, a slightly higher rate at the same bank, a promotional yield that expires in 6 months, resetting you to where you started. It feels like adjustment. It behaves like containment. Different interface, same spread, same outcome over time. So the pressure builds in a specific way, not from losing control, from realizing you've been optimizing inside boundaries that were never meant to improve your position in the first place. You adjusted the surface, you optimized behavior, but the return profile never moved, which means the rule set you've been following isn't connected to the outcome you assumed it would produce. The old frame is clean. Store cash safely, earn a small yield as a side effect of being responsible. Where stability and return are loosely connected, that connection used to be closer. Today, the national average savings rate sits around 0.4% to 0.6%, while large banks still anchor near 0.01%, even as top savings accounts range between roughly 3.8% and 5.0%. Same behavior, different output, which means the variable that changed isn't your discipline, it's how your money is being priced inside the system. Now remove the interface, ignore the app, the branding, the language. What remains is a liability entry on a bank's balance sheet, where your deposit is something they owe you, and they price that obligation as close to zero as possible. That liability doesn't sit idle, it gets deployed. Consumer credit in the US has been priced above 20% APR in recent years, with some portfolios approaching 30%, funded in part by deposits that cost almost nothing to maintain. So the gap isn't theoretical, it's engineered. Low-cost funding on one side, high-yield deployment on the other, with the difference retained systematically across scale. Picture a storage facility with glass walls. You can see your asset at all times, but each night it's duplicated, rented out at full market price, then returned before morning. unchanged in form, altered in economic role. Nothing leaves your account, nothing appears missing, but the value generated from that balance is being routed elsewhere, continuously, without interruption. That's the structure, not error. A system where the depositor absorbs stagnation while the institution captures movement. Now layer inflation onto that structure. Between 2020 and 2024, cumulative U.S. inflation reached roughly 19%. So a static $100,000 now carries the purchasing power of about $81,000 from just a few years prior. Then apply the yield. At 0.01%, that same balance generates about $10 a year. So while the number remains intact on screen, its functional value declines by thousands annually beneath it. That difference doesn't announce itself. It doesn't trigger action, because the brain registers nominal stability as safety, even when real output is quietly deteriorating. So the real return isn't low, it's negative in real terms. And it stays invisible because the metric you're watching, the balance, isn't designed to show you the loss. That's the inversion. You're preserving the figure. You're not preserving what the figure can actually do. Go back to the earlier moment, the declined $60 transaction. It felt like a system failure, but it was the only moment where the system exposed itself. The rest of the time, it operates cleanly. Balances update, access works, while the underlying pricing continues without interruption. And there's a reason it feels reasonable. Large banks are structured to maximize net interest margin, the spread between what they pay depositors and what they earn on loans. That margin isn't incidental, it's the core engine, which means your position inside that system is already defined. The moment your cash sits there, low yield, full liquidity, zero participation in the upside created from your own capital. And none of this requires a mistake, no missed payment, no bad decision. Just consistency inside a model that no longer maps to the environment it operates in, which reframes the entire situation. You weren't building yield, you were supplying it. And once that lands, a different question starts to form. Not where your money is, but why it's priced that way, and who benefits from that pricing staying exactly where it is. Because that answer doesn't sit in the rate, it sits in the structure behind the rate. Ownership model. Ownership model. Think of it as a building you enter every day. Clean lobby, fast elevators, predictable access, everything designed to feel neutral, like infrastructure, not a participant in your outcome. But you're not just inside the building, you're part of its input system. Every dollar you leave there becomes inventory that the building is structured to monetize on behalf of someone else. Not metaphorically, legally. Shareholder-owned banks are required to optimize return on equity, which means every balance inside the system is evaluated based on how efficiently it can produce spread. That obligation shows up in the numbers. In 2024, large U.S. banks reported net interest margins typically between 2.5% and 3.5%. That margin is the difference between what they pay you and what they earn using your capital. So, the building has a design constraint. Lower your yield, maximize deployment, because every 1% shift in that margin across hundreds of billions in deposits translates into billions in additional revenue. Now walk through a single scenario. No abstraction, just one balance, one behavior over a defined period. You keep $75,000 in a standard savings account at 0.01%. That generates $7.50 per year. At a 24 marginal tax rate, you keep roughly $5.70 after taxes. Same $75,000 in a 4.5% account produces $3,375 annually. After tax, roughly $2,565. That's a $2,559 difference in 1 year created without increasing risk on insured balances. Now extend it. 10 years. Assume rates normalize slightly. Average 3.5% instead of 4.5%. At 0.01%, your total earnings over a decade, about $75. At 3.5%, compounded annually, roughly $31,000. The gap is no longer marginal, it's structural displacement. And here's the shift. You didn't lose $30,925 in a moment. You never had it because the system never positioned you to receive it. Back inside the building, that $75,000 isn't idle. It's part of a funding pool that gets segmented, priced, and redeployed across multiple asset classes. Credit cards, auto loans, short-term commercial lending, all priced at rates multiple times higher than what your balance earns. So your capital participates, just not on your side. It's being used to generate returns you don't see while you absorb the opportunity cost of not accessing them. Now layer behavior on top. You check your account weekly, maybe daily. The number stays stable, small interest appears. Nothing signals that the underlying yield environment is completely different outside that interface. This is where the analogy tightens. The building has two floors. Ground floor, visibility, balances, transfers, debit cards, everything you interact with. Top floor, yield generation, lending desks, treasury allocation, capital deployment. You live on the ground floor, your money works on the top floor, and there's no elevator between the two for you. That separation is intentional because once the connection becomes visible, the pricing becomes harder to maintain. Now bring in inflation again. Assume 3% annual inflation over the next decade, below recent peaks. Your $75,000 loses roughly 26% of its purchasing power over 10 years. That means what feels like stability becomes about $55,500 in real terms. Combine that with near zero yield, you're not just missing upside, you're compounding a decline. This is where most people pause. They look for a better rate, maybe move to a slightly higher yield account within the same institution. That's the false floor, because the structure doesn't change. You're still inside the same building, just in a different room. Promotional rates, temporary boosts, 6 months later it resets, and the spread reasserts itself. The architecture holds because the objective isn't to eliminate the gap, it's to manage how visible that gap feels. Now, zoom out to income. Say you earn $120,000 annually. After federal and state taxes, you take home roughly $85,000. If $30,000 of potential yield disappears over 10 years, that's over 4 months of your after-tax income. Not through spending, through positioning. Time converts differently here. Not hours worked, hours that never had the chance to exist. And what this sets up in the architecture is the part most people stop right before reaching. Because once you see the building clearly, the next question isn't about rates, it's about access. Who is allowed upstairs? You don't think about it as a system, you think about it as being responsible. Money comes in, bills get handled, some stays in the account, stable, controlled, correct. That pattern feels like a choice. It isn't. It's a default configuration that was handed to you early and reinforced every time stability was rewarded over positioning. Save here, spend carefully, avoid risk, but no one defined what risk actually meant in terms of long-term output. So you optimized the visible layer. Clean balances, no overdrafts, no missed payments, no volatility, and underneath that, a structure quietly deciding what your money is allowed to do. That's the installed logic. Preserve the number, ignore the function of the number, and it runs automatically. You don't sit down and decide it each time. It executes the moment money hits your account. Think of it like an operating system, not the apps you open, the code underneath that determines what options even appear. Yours was written around storage and control, not yield and allocation. And whoever wrote that code benefits from it staying that way. Predictable deposits, low movement, low yield sensitivity, high retention inside the same structure. Now zoom into a single moment. You're about to spend $180. Not large enough to trigger concern, but not small enough to ignore. The check happens instantly. Balance is sufficient. The internal question runs, can I afford this? That question has a built-in limitation. It only evaluates the present. It doesn't calculate what that $180 represents in terms of time or alternative output. At a $100,000 salary, your after-tax hourly rate is roughly $35, so that purchase equals about 5 hours of your life. That translation rarely happens because the operating system doesn't call that function. Then there's a second layer it never reaches. If that $180 stayed in a 4.5% environment for 5 years, it becomes about $225. Small number until you realize this decision repeats hundreds of times across a decade. But that's not the real shift. The shift is earlier, before the math, before the awareness, in the framing of the question itself. Can I afford this? Versus what does this cost in time and what does declining it become? Different inputs, different outputs, same income, completely different trajectory over 10 years. And this isn't about restriction, it's about orientation. One version of you manages money as something to control, the other positions it as something to deploy. Those identities behave differently under the same conditions. One protects the present, the other allocates towards future function. Go back to the account. $50,000 sitting in a low-yield structure. It feels like discipline. From another frame, it's idle capital. Not because you're careless, because the system you're running never categorized it as something that needed to move. That's where the friction starts. Not technical, social. You begin to see it differently. You ask slightly different questions, and the responses you get from people around you don't quite match what you're seeing anymore. Why complicate it? It's safer this way. Interest doesn't matter that much. Individually, each statement holds. Collectively, they anchor you back into the same structure, the one that keeps the spread intact by keeping behavior predictable. So you sit with it. Not convinced yet, but no longer aligned with the default. There's a moment where it settles, quietly. No excitement, no urgency, just a recognition that something you treated as neutral was never neutral. The account wasn't just holding money, it was defining what your money was allowed to become. And once that clicks, the earlier pieces rearrange. The rate, the structure, the building you've been inside this entire time. You see the floors now. You see where you've been positioned, and for a second it feels complete, like the picture finally makes sense. That's the false resolution, because seeing it isn't the same as choosing differently. Most people stop here. They understand the structure, they keep the same behavior, not because they agree with it, because the default is still running, and changing it requires stepping outside a system that was designed to feel like the only stable option. So the question tightens. Not what the system is doing, not how it works, but whether you're willing to run a different one. You don't need more information. You already saw the structure. The only thing left is what happens the next time money lands in that account. Same interface, same options, but now you know what each option actually does over time, even when the screen looks unchanged. Leave it where it is, it continues pricing your balance near zero. At $50,000, the difference between 0.01% and 4% is roughly $2,000 a year, about 57 hours of after-tax work at $35 an hour, gone without a line item. Move it differently? The number doesn't feel dramatic, but the arithmetic underneath it starts compounding in your direction instead of away from it. Both paths look stable. Both feel reasonable. Only one of them is aligned with how the system actually behaves beneath the surface. And nothing announces the difference. No alert. No moment where it tells you this is the decision that mattered. It's just the next transfer, the next place you let it sit, the next time you accept the default or don't. Because from here, it isn't about understanding the system anymore. It's about whether you keep making decisions inside it or start making them as if you never agreed to its terms in the first place.